Section 8. Unit 6, VA Loans and the Consumer. Introduction and Objectives. Lesson 1, Can this veteran use a VA home loan? Lesson 2, Will a VA loan work for this purchase? Lesson 3, Review of Government Loans. The Certificate of Reasonable Value. As you know, when financing a real property purchase, lenders will require borrowers to obtain an appraisal of the property. The appraisal helps the lender determine whether the underlying value of the property makes it suitable for use as collateral on the loan. With a VA loan, this appraisal must be in the form of a certificate of reasonable value, and must be performed by a VA-assigned certified real estate appraiser. A CRV has a shelf life of only 6 months for resale properties, and 12 months for new construction. So what happens if the appraiser returns a CRV that's less than the sales price? A borrower who still wants to move forward with the purchase has these options. Pay the difference in cash. Get the seller to reduce the sales price to match the CRV. Some combination of the two. When the borrower makes up the difference in cash, the VA has the right to approve the source of these funds to ensure that they're not a loan, which would alter the borrower's debt ratio and put the borrower at a higher risk for default. The VA guaranteed loan, qualifying the borrower. In contrast to FHA loans, which use two types of qualifying ratios, the VA asks lenders to focus on a calculation of residual income along with a debt-to-income ratio. Residual income. Residual income is the amount of net income remaining, after deduction of debts, obligations such as utility and phone bills, and monthly shelter expenses, to cover family living expenses such as food, healthcare, clothing, and gasoline. The minimum amount of residual income a borrower must have is set forth according to geographic area and number of family members. For example, debt-to-income. The VA's debt-to-income ratio calculates total monthly debt payments, housing expense, installment debts, such as utilities, and other debt, against gross monthly income. Borrowers should come below a 41% ratio to qualify for a VA loan. Lender judgment when qualifying. Both the residual income and the debt-to-income ratio are used as a guide to assessing credit risk, but lenders are not expected to automatically approve or reject a loan on the basis of either calculation. Compensating factors that the lender may consider when qualifying a borrower are similar to those allowed by the FHA, such as excellent credit history, minimal debt, long-term employment, significant liquid assets, large down payment. New loan represents little or no increase in housing expense. High residual income. Low debt-to-income ratio. Tax credits for childcare. Tax benefits of home ownership. Credit scoring. Although compensating factors like those listed above do not offset poor credit, the VA is lenient about credit scores. While the Department of Veterans Affairs hasn't identified a specific minimum credit score requirement, lenders do establish minimum credit score requirements. For many lenders, this minimum score is 620 with a VA loan, which is a much lower score requirement than is needed for conventional mortgages. Qualifying for a VA loan after bankruptcy or foreclosure is also possible, even if the foreclosure was on a previous VA loan. Typically, someone who has gone through a bankruptcy or foreclosure has to wait for 2 years before using a VA loan. This is a significant difference from the waiting requirement for a conventional loan, which is 7 years. The type of bankruptcy makes a difference. Keeping VA borrowers from defaulting. Why is underwriting a VA loan a little different than other loans? The VA strives to make sure that the borrower is going to be able to stay in the home long term. Their underwriting requirements are very careful to leave the borrower with enough money for other needs and discretionary expenses after paying their housing expenses. For example, lenders are asked to consider if the borrower is purchasing a home in a high-income area where they may feel compelled to have higher expenses in an effort to keep up with the Joneses. That extra burden may affect the borrower's ability to qualify for the loan, whereas the same borrower purchasing a similarly priced home in a lower-income area may not incur the same level of expense. The fact is, despite the fact that most VA borrowers make no down payment, VA mortgages default at a lower rate than even prime loans, according to Fannie Mae and Freddie Mac requirements. Eligibility requirements for the VA loan. Not every veteran or current service member will qualify for a VA loan. The applicant must have sufficient credit, income, and a valid certificate of eligibility, COE, to be eligible for a VA guaranteed home loan. A COE is a document provided by the U.S. Department of Veterans Affairs stating whether an individual is eligible for the VA loan, and the dollar amount of eligibility available. The veteran doesn't have to have a COE to get started. Sometimes lenders can obtain one after the veteran has applied. Veterans who wish to order their own COEs may do so on the VA Benefits website, which explains the process to obtain a COE. The individual's length of service or service commitment, duty status, and character of service determine eligibility for specific home loan benefits. Only honorably discharged veterans are eligible, with some exceptions. However, provided they otherwise qualify, active duty, reserves, National Guard, surviving spouses, and even some other government employees can use the VA loan. Service members who don't meet the minimum service requirements may still be eligible if a discharge occurred due to hardship, the government's convenience, a reduction in force, certain medical conditions, or a service-connected disability. Use of property for a VA loan. Property purchased with a VA loan must be for owner occupancy. The loan can be used to buy a home or a condominium unit in a VA-approved project. Build a home. Simultaneously purchase and improve a home. Improve a home, e.g., installing energy-related features. Buy a manufactured home and/or lot. Borrowing limits for a VA loan. The COE is the final word on how much entitlement a veteran has available. The amount of entitlement effectively dictates how much home the veteran can purchase without putting money down. The basic VA entitlement is $36,000. This would be sufficient for a mortgage of up to $144,000. If the mortgage is only $120,000, the VA still only guarantees 1/4 of that, $30,000. That'd leave the veteran with some remaining entitlement, which is called partial entitlement. Because the VA guarantees 1/4 of the total loan amount, a secondary entitlement kicks in if the home value is higher than $144,000, raising the government's repayment pledge to a maximum of $104,250. This level of entitlement means that veterans throughout most of the country can borrow up to $417,000, that's $104,250 x4, without a down payment. The amount the VA will cover depends in part on the area where the property's located. A higher entitlement will be available in more expensive parts of the country. Funding fee. The VA funding fee charged to buyers using the VA loan keeps the program funded. The COE will also be used to determine whether the veteran pays the funding fee, and how much it is. The funding fee may be reduced if the veteran provides a down payment, and it will be waived completely if the veteran has 10% or higher VA disability. Restored and partial entitlement. The entitlement isn't a one-time use deal. Veterans who have used a VA home loan benefit and paid the loan off completely can borrow again under the program, with the same level of entitlement. This is called restoration of entitlement. In fact, veterans may be able to get another VA guaranteed loan, even while still owing on the prior loan, if their entire entitlement amount weren't used in the first loan. This is called partial entitlement. Of course, they would need to qualify for both loans, and a down payment may be required for the second loan. Restoration of entitlement is allowed, though not automatic. The veteran must apply to restore entitlement, under any of the following conditions. The property's been sold and is no longer owned by the veteran, and the loan is paid in full. A qualified veteran buyer assumes the outstanding balance on the loan and agrees to substitute his or her entitlement for the same amount of entitlement the original buyer used to get the loan. The new buyer must qualify for the VA loan with the lender. The borrower has repaid the prior VA home loan in full, but hasn't disposed of the property securing that loan. The entitlement used in connection with that loan may be restored. Example. Bob purchased his home 30 years ago using his VA loan benefit. He's paid it off and still owns the home. He can restore his entitlement and purchase a second home using the VA loan benefit, provided he meets all other qualifications. This one is a one-time only benefit. The VA loan, special rules for applying and closing. Certificate of reasonable value. VA loans come with certain rules that lenders and borrowers must follow when applying for and closing the loan. The VA requires a VA-assigned certified real estate appraiser to provide a formal estimate of value for the property, resulting in a report called the Certificate of Reasonable Value, CRV. If there's a difference between sales price and CRV, the guarantee is based on the lower value, which means that a borrower who still wants to close the loan must bring cash to closing to make up the difference between sales price and CRV. Closing costs. Closing costs can't be added into the sales price, and are limited to specific costs, which must be paid in cash at closing. The only allowable closing costs that may be charged to the veteran are up to a 1% loan origination fee, discount points, if applicable, VA funding fee, see below, reasonable and customary charges for the appraisal, borrower's credit report, recording fees and/or taxes and/or assessments chargeable to borrower, initial deposit for tax and insurance escrow account, hazard insurance, including flood insurance, survey, if required, title examination, and title insurance. The veteran borrower isn't allowed to pay for the termite report, unless the loan is a refinance. That fee is usually paid by the seller. Also, no commissions, brokerage fees, or buyer broker fees may be charged to the veteran buyer. Payment of closing costs can be negotiated. The VA appraisal, borrower's credit report, state and local taxes, and recording fees may be paid by the buyer, the seller, or negotiated to be shared between them. Funding fee. Although there's no down payment requirement and no mortgage insurance premium, the VA does charge a funding fee, which covers expenses in case of borrower default. The funding fee may be paid in cash or included in the loan amount, even in excess of the CRV, as long as it doesn't bring the total over the maximum allowable loan. All veterans pay the funding fee except for those receiving compensation for service-connected disabilities, those receiving retirement pay in lieu of disability compensation, and spouses of veterans who died in service or died from service-connected disabilities. The funding fee may also be waived in cases where the veteran makes a large down payment. Buy downs. In times of higher interest rates, some borrowers will choose to buy down interest rates to a level that creates a more comfortable monthly payment. Buydowns are allowed only on VA fixed rate, not adjustable, loans, and the fee for the buydown may be paid by seller, buyer, or family members. Qualification for the borrower is based on the first year's payment rate. Seller concessions. Seller concessions are allowed with a VA loan, but they may not exceed 4% of the sales price. Seller concessions are considered anything that a seller wouldn't typically pay in a transaction. If a seller elects to pay any of the buyer's closing costs, not including prepaid items, or discount points for a permanent buydown of the interest rate for the buyer, those amounts are not included as part of the 4% seller concession limit. However, points paid on behalf of the buyer must be within reason in relation to the current market. For example, if the market dictates an interest rate of 7.5% with 2 discount points, the seller's payment of the 2 points would not be a seller concession. But if the seller paid 5 points, 3 of these points would be considered as seller concession. Allowed seller concessions include, but are not limited to, the following. Payment of the buyer's VA funding fee. Payment of the buyer's prepaid property taxes and insurance. Gifts, such as a television set or microwave oven. Provision of escrowed funds to provide temporary interest rate buydowns. Payoff of credit balances or judgments on behalf of the buyer. VA Specially Adapted Housing Program. VA Specially Adapted Housing Program. The Specially Adapted Housing Program is a grant program. So it's different from a loan, you don't have to pay it back. And it's meant to help certain severely disabled veterans either adapt or build a home that will help them to acquire a barrier-free living environment in their own home. It's available to certain severely disabled veterans and it helps them live more independently in their homes. What adaptations are available with the SAH grant program? The adaptations that are available are fairly flexible because every veteran is different, every home is different, and everyone's needs are going to be unique.